Hi, and welcome to Midas Investing. Today we're going to be taking a look at Fidelity National Financial, ticker FNF. We've covered this company on the channel a couple times before, and it's been a major position within our portfolio for quite some time. Fidelity is the largest provider of title insurance in the US mortgage market, as well as a provider of other real estate services. They also are engaged in the annuity business with their acquired segment of F&G, which is a separately traded company, which I covered last week. And I'm not going to go over my model for that particular company since I already covered it in a separate video. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. If you're not aware, title insurance is a form of insurance that you have to purchase whenever you engage in most real estate transactions within the United States, as it says here. Effectively, it protects both the buyer and seller against any sort of uncertainty within the value of the title, damages that are not recorded by one side or another, and a variety of other things like that. It says here within this section, the U.S. title industry is actually very heavily concentrated. According to Demotech, the top four insurance groups accounted for 79% of the net premiums written in 2021. And 34 independent title groups accounted for the other 21%. FNF being one of the largest with approximately 32% market share within the last year, that shows that they have the lion's share even amongst those top four players. It gets into some of the more specifics of how the situation is handled. A policy is opened by the purchaser or the transactor within the real estate transaction itself. And then there is a decent amount of back and forth between the title insurance while they evaluate the property and make sure that the title is worth what is presumed to be worth. And there's a report put out that's then circulated to all the various parties. Money is put into an escrow, which FNF also provides services for. And then after the transaction is closed, the assets are then released to the various parties that they belong to, at which point the premiums can then be transferred to the company. Now, one thing to understand about FNF and the title insurance industry in general is that they operate through a little bit of a dual system where there is direct operations for the main companies having a direct service provided by their main employees at their main offices. And then there's also agency operated operations where there is independent title insurance agents who then can go out and search for transactions to cover for the company, and then they relay a significant portion of the premium, usually a minority relative to the agency's cut, back up to the title insurance company. And in fact, the majority of FNF's revenues do come from these agency operations. As it shows right here in this table, the direct operations for 2022 accounted for about 42% of their title revenues versus about 58% for the agency premiums. And one thing to understand further about these agency transactions is that while this does allow for a much larger expansion of their business, as I said, the lion's share of the business does come from these agency operations. That does mean that they're going to be less profitable because of the fact that they only get to keep approximately 40% of the premiums. And I arrived at that approximately 40% number after working backwards through their agency revenues to their total overall revenues to figure out that approximate number. And it seems to be pretty stable over the long run. Now, FNF's title revenues are further bifurcated by a separation between original purchase transactions and mortgage refinance transactions. This table shown here by the Mortgage Bankers Association has the actual numbers from 2021 for the mortgage market, showing about 1.8 trillion in original purchase transactions and 2.6 trillion in refinances, for a total of about 4.4 trillion in the overall US or mortgage originations market in 2021. And then they also have projections for what they expect it to be for 2022 through 2025. Yes, obviously 2022 already came to a close, but they don't get the full numbers for this till several months later. So this number at this point in time was still considered to be mostly a projection. Now, I'm not going to build my model up with a separation between purchases or refinances, but I did want to point this out because we are going to at least still lay in our expectations for overall demand of the mortgage market and the orders that we're expecting for them in the long run, based upon the fact that this larger amount of refinance transactions that we saw in the last few years are going to come back down to a longer smooth average over time. But in terms of thinking about these projections, I do want to point out one interesting thing that I saw when looking through these reports and these tables that are reported by FNF within their 10K year after year. This is the 2022 annual report, as I said, and it shows the numbers right here. And you can see, for example, that 2022 was expected to be 2.2 trillion, with 1.9 trillion for 2023, 2.3 trillion for 2024, and then 2.5 trillion for 2025. If I switch, however, to the 2021 annual report 10K, you can see that the expected numbers, or the expected numbers for 2021 was 4 trillion versus that. So it was actually higher in 2021 than was expected, which was borrowing effectively the amount from 2022. And then the number in 2023 was expected to be 2.5 trillion versus the 1.9 trillion that is currently now expected to have been in the more recent report, and then showing also 2.5 in 2024. So you can kind of see that how their bounce back up from the lows is effectively being pushed out further each year with these projections. So we do want to take these with a little bit of a grain of salt. Now, switching over to their presentation that they had from last winter, they talk about in their 10K about the 32% of market share they currently have within the title industry, but I wanted to show how that is dispersed against some of their major competitors. You can see some of the larger competitors that they have relative to the total title industry, and then you can see it's separated by direct versus the agency operations, as we were talking about. One thing I want to point out with this is, as I was saying, the direct operations are more profitable, and you can see that Fidelity actually has the larger lion's share of that part of the market, which allows for them to be more profitable than their competitors in general. In fact, against these particular competitors, they actually show their overall margins in this particular slide further down in the presentation, showing that over the 10-year period right here, you can see consistently much higher margins against that particular cohort. Now, coming back up to talk about the market share a little bit further, they show the market share dispersed by geography. You can see that they're very, very well dispersed across the entire United States and through the entire United States title insurance market. So, yes, there's going to be obviously some areas of the country that are a little bit hotter in terms of real estate versus others. But I'm not really separating by geography because of how well spread they are across all the different states in my projections. And then in this slide, they actually took those mortgage origination numbers from the MBA table, as we were talking about, showing here over the last 10 years. And then they next to it put their revenues as well as their operating margins. So you can kind of see just how key this overall mortgage origination market is to their actual revenues, considering they're effectively getting a small cut of that. Now, in terms of thinking about the U.S. mortgage market over the long run, I did go looking at some of the economic data on the Federal Reserve website. In this chart right here, in the blue, we have new one-family homes for sale in the United States at any given point of the month over the change in population in terms of actual people over that particular monthly period. And then I ended up adjusting it by 12 because of the fact that it was a monthly amount, so that it turns it more into an annualized population growth. So it's basically saying like how many new homes are being sold in the United States relative to the growth of the population, the amount of people that are being added to the population each year. You can see that it's actually relatively consistent over the decades for the most part in this this kind of 1 to 2 kind of range of a ratio. And then you can also see the population growth in the red line in terms of thousands of people on the right, or millions of people, my bad, on the right. Obviously, because you see this huge spike up and spike down when the population declined pretty significantly, well, or at least came close to declining pretty significantly in 2021, due both to a shrinkage in immigration as well as losses to COVID. Pretty significant change over there. Probably also a drop off in the birth rates. We had actually seen a somewhat decline in the overall birth rates for the last several decades right here. And also, I believe you can see a marked decline in immigration for the years 2016 through 2020 as well. The point I'm trying to get here is that in our current point, we're at a ratio of over 3, like maybe around 3.5 or something like that, getting back down to kind of a more normal level of amount of homes for sale relative to the population change would mean that we would either have to get at least a third of the homes that are for sale off the market, or we would have to significantly increase the amount of population change. Now, from my understanding, due to the current policies of the government, it's very possible that the immigration levels might start to take up a little bit more relative to the several past years, but that's not necessarily a given plenty of other economic problems that are ongoing, and birth rates are very hard to reverse, so I don't necessarily think that that's an option. So it might be that homes are going to have to come off the market to get us back down to this more normalized level in terms of how many homes are relative to the amount of people, which is how I'm kind of measuring demand in this particular measure. Now, this is just one way of sort of thinking about it. I also pulled open another measure, which is new one-family homes for sale in the United States over the new family homes sold in the United States. So it's a little bit of a different metric, more thinking about the actual homes that are currently for sale versus the amount that actually stopped being for sale. You can see the kind of ratio average maybe over the sort of long run is maybe, I don't know, maybe 6, 5, 6. I didn't take the spreadsheet out to actually get the specific average. I was just kind of getting this kind of visual information about 5 to 6. You can see that during 2008, during that particular housing crash, it spiked well up over 12, pretty significant jump up, and then cratered back down to relatively low levels, and then coming back into this kind of normalized range. I would also point out back during the inflationary period of the 70s, it did somewhat of a similar activity. It also spiked up a little bit in the early 1980s when we were entering the tightening period following that inflationary period. So if you kind of like use that historical information as sort of a guide stone for like where we're headed, but also take a look at where we currently are, we're only currently around maybe like the 7.5 kind of line, which isn't necessarily that far from more of a historical average. It is above average, but it's not necessarily crazily so. So comparative to maybe the other measure, this one shows that overall amount of homes for sale relative to the homes being sold is not necessarily too extreme. It's still just a little bit hot with some room to come down back to that average. Of course, things often do go past the average on their way back to a normalizing level. So that doesn't mean just because it gets to an average, it stops there. It could likely go further than that at first and then swing back the other way. One more measure of kind of real estate demand relative to supply within the market that we're going to kind of look at before we get into my model is a little bit of a simpler one. The median number of months of on the sale for newly completed homes. This one paints a little bit of a different story. You can see kind of the more historical average, I'd say, is maybe around 5 or something like that. Or over the long run, pretty consistent. We don't have the early 70s to look at for this particular chart, but we do have the tightening period of the early 80s. You can see it did spike up to 10 and then came back down pretty quickly, relatively sharply. And then back during 2008 in that particular crisis, it also spiked up over 12 and then it came down a little bit of a slower come down, but eventually coming back down to a normalized level. And then the normalized level it came down to was actually a bit of a lower level here. And the threes or something like that, and then it's actually even been relatively lower than that. We're still in relatively low territory for that. So like from this particular measure would argue that there's actually no particular issue with in terms of the total supply on the market. In fact, they would argue that we just have really high demand from this perspective. So depending on which angle of the information you look at, you can kind of get a slightly different picture, I guess, is the point I wanted to show here. But there's plenty of argument to say that we still have room to come down in terms of the cooling off the demand. But I would also say that we're not necessarily too far from a bottom based off of the summation of all of this information here. All right, so coming over here to take a look at the model that I built for the company. Up here at the top, you can see the mortgage origination numbers that we got from the MBA that I was showing before, as well as the current projections that they had for the estimate of 2022 onward up through to 2025. Also, the market share numbers that was given from Demotech is listed right here. And then based off of those two pieces of information, I essentially just worked from that point there to get an estimate of the total market serviced by FNF. And then I took the title revenues that they had, their direct revenues, the agency revenues, as well as the escrow and other revenues that they have, their overall title revenues as what I'm calling the market take, is basically the percentage of that inside the market that they service, getting an idea of effectively like what's the fee that they're charging to their real estate customers effectively overall, not just for the title insurance, but also, like I said, including those escrow services as well. In fact, you can see that the average that they had over the 10 years is about 1.2%, which is approximately the range that you expect for title insurance. The kind of like rough rule of thumb that you hear online is something like 1%. So that's within the range of expectations of what we would see for that. There's definitely variability within it, 1.8% one year, down to 0.7% in other years like that. Then I also have right here the direct number of orders open in terms of millions of orders opened. Now this is the opening of the order, not the closing of the order. It's worth noting that they book the actual premiums as revenue once an order is officially closed. And I talked earlier how there's a little bit of a process of evaluating the property and stuff like that, and moving all the documents to the parties involved. And so there's a little bit of a lag between this process. Lots of orders tend to get canceled in the interim as enthusiasm for the transaction fades or something like that. So I do have the direct orders opened in this particular line, but I bring that up because I also have the direct orders closed showing right here. As I was saying before, the orders closed is how the revenues are booked. So we are going to essentially take the average that we have for the period between 2013 through 2019. I chose this partially because it's prior to 2020 and all the craziness since then, but also it's a slightly more conservative number than the longer term average. And the average is about 1.4 million orders closed per year. So we're going to use this as our general average guidestone for the market returning to a normalized level, and that being the projection we're going to use for the orders that they'll have direct in 2032, 10 years from now. But the orders open is going to be a useful piece of information for predicting the other piece of information required in order to actually make a projection for the direct revenues, which is the direct fee per file. Fees per file direct multiplied by the orders closed is going to get us our direct revenues. Now the fee per file, they actually do give us that information in the 10K. I have that year over year listed right here. And you can see that it increased about 6.6% through 2013 through 2019. And then that increased the annualized level, if you all go up to 2022, up to almost 8% over that entire time frame. If you multiply the direct fee per file times the direct orders closed, you get the total amount of revenues that you would expect the company to have from their overall take of direct orders, which is 95% correlated with their overall direct revenues with 90% explanatory power. It is effectively where this number comes from. There might be some fuzziness and timing differences between a few of them, as well as some extra percentages and fees for various other little details added on or subtracted for various reasons. But effectively speaking, that's where the direct title revenues come from, is multiplying direct fee by file times direct orders close. Now the question is how do we measure how fast the direct fee per file is going to increase by? It turns out that if you take a look at the US average home value per year, which had also for the period between 2013 and 2019 had increased almost 3% per year, which had increased to almost 6% per year up through 2022. If you take a correlation between the direct fee per file and the average home value, you can see that they are 77% correlated with a 59% explanatory power. Not exactly precise, because there's definitely going to be lots of wiggle room in there depending on the company looking at, but it makes perfect sense considering, as we saw before, the fees that they can charge are effectively a percentage of the overall market service, and the overall market service is going to be directly correlated with the price of the homes within that market going up or down, as you would expect. So effectively speaking, if we're trying to figure out what direct fee per file that they're going to be able to charge 10 years from now, we need to have some sort of projection on where we think US home values are going. Now coming back over to the Federal Reserve website, I pulled open two major indexes of the housing prices in the United States, and you can see the year over year movements going backwards to the late 1970s. You can see during the period where the monetary tightness has started to come in after the inflation, we did have a period where housing prices, the year over year growth came down pretty significantly before bouncing back up. And then likewise, in the period of the housing crash, we had it reaching pretty high levels before coming down to pretty significant negative numbers for at least a couple years before eventually bouncing back up. Here we are back again on the decline from rather extreme levels. A lot of people are wondering where it's going to bottom out, if it's going to bottom out in significant negative territory, or maybe just bottom out in relatively kind of low, near zero territory, or what. And also the question is for what sort of duration. Now I took the data from the Federal Reserve and downloaded it to actually calculate some statistics on it, taking a look between the two different indices, which I have the statistics for each of them here, and then I just took an average between the two indices. Overall, you can see that the average annualized growth rate, if you're looking at monthly periods, ends up being just under 5% per year, the mean of which being about 5%. The third quartile, so where approximately 75% of the values are lower, is about 7.5%, and then likewise 25th percentile, where about 75% of the values are higher, it's about 2.3% or so. I did the same calculation for the period between 2007 and 2016, which is a 10-year period following where approximately where they were in the same kind of decline arc, or so to speak, back in 2007, 2008. And you can see for the 10 years after that, the growth rates that were likely to be found on average was 0.1% with a median of negative 0.2. On the third quartile, we got 5%, and on the first quartile, we got negative 4.2%. So I'm really going to rely on these numbers right here as basically just a very conservative estimate. I definitely am very pessimistic about the mortgage market to a certain extent. I see reasons why that pessimism can be wrong, but I definitely would much rather be surprised to the upside than than otherwise. So effectively speaking, I'm going to make a bullish base and bear case for my title revenue projections, basically by changing one factor, which is just these growth rates for the mortgage market, and then relying, as we'd seen previously, on that average direct orders close level for the overall projection. So coming back over here, you can see the base level of negative 0.2% is already placed in here, which gets us to an expected level of $517,000 for the average US home value in 2032. Now for the direct fee per file, I'm not actually relying on that exact percentage. As we saw before, it's not exactly that. There's some fuzziness around the percentage. There's just a super high correlation and strong explanatory power associated with it. So what I chose to do is take that base percentage as the level and then adjust it for the amount that the direct fee per file for the last 10 years had effectively been running ahead of the US average home values change year over year during that same time frame. So we're effectively just adjusting it and saying that this is going to mean revert to a certain extent, which gets us to a negative 2.3% for this base case assumption, which gets us to a direct fee per file in 2032 of 2,600 some and change. Taking those assumptions together, that gets me to direct revenues in 2032 for title of about $3.8 billion or so. And as far as making projections for the agency revenues as well as the escrow revenues, as we'd seen previously, the agency revenues are generally a percentage of the similar type cut for the direct revenues, as well as they are then a multiple of the total amount of the direct revenues based off of the overall types of demand situation within the market. I didn't want to make any sort of projections of what type of percentage relative to each other that was likely to be. I didn't think that I could necessarily add anything super useful to that information. So really, I just took a look at what the ratio of agency to direct has been over the long run. And I looked at both the period of 2013 through 2019, as well as the overall from 2013 to 2022. And I just chose the more conservative of the two, which is 2013 through 2019, getting us a ratio of 1.2. And if I use that ratio, that gets me to agency revenues of 4.65 billion in 2032. A little bit of a crude estimate, but like I said, I felt like breaking it down into further disaggregation than that wasn't going to be more helpful. I didn't really have anything useful to add there, I didn't think. Using basically the same methodology for the escrow and related other revenues. However, for this one, we ended up using the most recent 3-year average because that's actually the more conservative of the choices. So that's basically the choice we went with. And that got us to 3.5 billion, 3.6 billion or so in 2032. If you add all those together, we end up with title revenues in this base case of about 12 billion. Now, the elephant in the room, as I had talked a little bit at the start of the stream, my video from last week about F&G, which is the other section of their business that comprises maybe about a third of their overall business, or really about a quarter of their business, but might grow into a third or whatever. You'll have to check out my video from last week on that, which has a much more elaborate model going into the outcomes and potentialities for F&G. But for this FNF model, I'm actually just going to use my expected revenues for the F&G revenues for each of my cases in here, because I didn't really want to have it an overly complicated probability matrix between the two, since they have two entirely different models that are going to go in different directions, and that there could be an interesting mix between the two. So overall, our expected revenues for F&G is about 2.6, 2.7 billion or so, and the investment revenues that we get between that is 2.9 billion or so. Now, the investment revenues, this is one thing where we actually do adjust it a little bit from the F&G assumptions, whereas FNF does actually have some investments that are separate from the FG ones, but they're going to be managed approximately within the same methodology or so. And so really, I just multiplied the overall balance of the investments up by the ratio they've been for the last few years, which is about a 1.1 ratio or so. So technically, the investment revenues I listed here are slightly higher than the investment revenues that I listed in my FG video, because I'm trying to account for the FNF specific investment balances as well. And I did likewise with the also gains and losses in the FG video. The gains and losses on average netted out to 0, which makes sense over the long run if you're actually holding your bonds to maturity. But the average for FNF was actually negative 48 million due to some relatively larger unrecognized losses in some of the years, and I just chose to add that slight extra layer of conservatism in here as well. put together, all in, that gets us to a base case FNF total revenue of $17.6 billion in 2032. Now, as promised, like I said, we can adjust our case assumptions for different home values and how that would change the overall fee profile, the expectations that we have. For our bull case assumptions, we switched the home value expectations up to 5% per year, which would get us to a home value of $859,000 or so on average in the US in 2032. And with that, that gets us to title revenues of 20.2 billion and FNF revenues of 25.8 billion or so. Likewise, if we switch the growth rate to negative 4.1%, which was our bear case assumption, that brings us to an average US home value of $347,000 in 2032, which brings us to title revenues of 8 billion in 2032 and FNF total revenue of 13.6 billion or so. Switching over to my financial statement spreadsheets, you can show the gross margins here in this chart along with the cost of goods over time. You can see their gross margins had been at a pretty high stable level here at around 70%. And has dipped down a little bit in the more recent years with the acquisition of FG, and also with a little bit of the change up in the terms of the types of transactions they've gone with the larger acceleration of refinance transactions as well as agency relative to direct, that lower the overall gross profit margins as a percentage. But with that, you can see also the SG&A as a percentage of sales also came down during this period as they were scaling up a bit, and also that similarly with less direct operations relative to agency meant less SG&A as well. And with the F&G acquisition also, which has slightly higher margins, the operating margin has edged up slightly in a slightly more sustainable way. At least some of this is sustainable, some of it will come back down. But you can see either way, pretty strong sustainable margins. And coming down here, you can take a look at the actual average of that adjusted operating margin, which over the last 10 years has been about 13.4%. Past operating margins, the amount of cash flows that they've had to invest or reinvest in their business from their profits in order to sustain the growth. As a percentage of sales, the overall reinvestment on net has been approximately 2% over the last 10 years, with a pretty strong variability, however, with a large negative percentage in 2022, what with a large shift in financial investments now that they have a large investment portfolio with the acquisition of F&G, kind of shifts the type of reinvestment and the volatility of it that you can expect within given years. And then back in 2014, they had a large positive number with the changeover of certain assets and the removal of certain non-core segments. So with both of those years in there, that might be thrown off the average, but if you take both of those kind of possibly outliers out, you still end up with this kind of like 1 to 2% range per year of percent of sales reinvestment. Over the future projections, I'm assuming that there's actually going to be a little bit of a higher level of reinvestment because of the F&G acquisition. So coming over to the valuation spreadsheet here, taking a look at the expected distribution of revenues. You can see the bull case revenues a little bit shy of the actual number that we came up to. Similar with the bear case, they're approximately within the ranges for the bull base and bear cases that we came up with based off of the home value growth rates. Also, it's worth noting that I did make assumptions about the short run that was really basically cutting the difference between the analyst expectations as well as the implications implied by those MBA projections. The MBA projections, if you kind of implied it based off of the other assumptions in our model, assumed a little bit of a higher decline in revenues within this year, whereas the analysts seem to be projecting a relatively modest decline this year. I kind of chose to kind of cut the difference between the two. So my expected revenues in the short run is still for a decline here in 2023, and then a return to growth in 2024 and 2025. Which I think is a pretty reasonable case to assume. And then I already kind of laid the assumptions for how we get to those longer term revenues, and I just kind of plugged in numbers to get us to that point from that point onward. You can see the cumulative growth cases between the bull, base, and bear case here, as well as incremental growth outcomes listed here. In terms of the operating margin assumptions, I am assuming that their operating margins over the next 10 years on average will be a little bit weaker than they were over the last 10 years, coming down to about a 12.4% relative to the 13.4% we saw previously. And then also in the terminal year, I have them coming down even further, closer to more of an industrial average, which I think makes sense for the terminal case for them. Within the short run, however, we do have margins coming down much closer to the lower end of the end of expectations we saw historically, and then kind of in the midterm, we also see a little bit of a bouncer up point to some higher margins at one point in the future. And then between the cases, we kind of have just a larger spread of variability between them. You can see the spread of the operating margin cases that I have in this graph right here, overall kind of staying in this kind of like lower to mid-teens range. Operating income quartiles right here, as well as the terminal operating income as a distribution listed right here. You can see approximately 2 to 2.5 billion is the expected operating income in 10 years. For reinvestment and expected free cash flows, as I said before, I was increasing the expected reinvestment as a percentage of sales up to more like 3 to 4% on the expected case overall, which you can see gets us to a wider spread of potential free cash flows of anywhere from 1.1 billion in the first quartile to possibly 1.4 billion in the third quartile. On expected case, we see about 1.3 billion. Returns on invested capital quartiles are going to stay in a relatively tight range, relatively speaking, compared to some of the other assumptions, but still staying at a pretty strong invested capital or returns on invested capital level. With the bulk end of capital investment here, you can kind of see coming in some of the earlier years and then starting to level off in later years. Free cash flow distribution you can also see right here. And with relatively modest terminal growth assumptions that assumes that they're going to grow at a rate that is in real terms going to be negative into perpetuity, which gets us kind of a relatively low teen level terminal multiple implied. You can see the expected value we end up with is about $40 per share. A first quartile about $35 per share, third quartile about $47 per share. You can see the fair value distribution here, as well as the expected returns distribution. Significant potential for decent returns. I would also point out that you can see that it's showing that there's really no chance of negative returns. There is obviously potential for subpar returns, but not really a whole lot of loss potential in the long run at a minimum here. As well as you can see the expected summary case right here. The percentile of the value distribution that it's currently trading at is about 22%, which means that approximately speaking, there's 4 times as much outcomes to the upside as there is the downside. So while it's maybe not necessarily the most exciting of upside potential at only about 24% upside to fair value and about 12% expected returns for the next 10 years, I would say that those are relatively solid returns that you can pretty much count on. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's my valuation of FNF, Fidelity National Financial. I hope you guys enjoyed the model that I put together for this company. And as I said, it kind of relies on the expected case of my F&G valuation, which if you didn't catch the video for that, it's kind of an important thing to understand about this company if you're going to invest in it, which I said likewise for F&G and FNF. So you should check out that video as well if you're in any way interested in checking out this company. I'll catch you all in the next video. Bye.